I think one of the most underrated skills of a CFO or anyone in finance is being a good storyteller. And the most effective and impactful CFOs and finance people are the ones that are able to tell a good story to the market, a good story to investors, a good story to the board. There are times where I've leaned more on the technical, right? Like, gotta be technical, you gotta be accurate, gotta be this. And that's all fine. And you should. That's kind of table stakes.
Hi, Joy. Thanks so much for joining us on the Two Cents podcast today.
Thank you. Thank you for having me.
Before we get started with our conversation, do you want to just introduce yourself to our audience a little bit more and talk about your kind of journey in finance and to your current position?
Yeah. So my name is Joy Mbanugo. I am currently the CFO at a publicly traded company here in the Bay Area, California. For those of you who don't know, when we say Bay Area, called CXAI, and we're an employee experience company. And so like my path to becoming a CFO was not linear. So just for people who want to become a CFO, to give them a little bit of background, like the three very traditional routes to become a CFO are controller, investment banker, or FP&A. I did, but not really. My core foundation came from working at EY. I was an audit nerd. I worked in tax, and so I was there for about 12 years and, like, built a really big regulatory framework, and you couldn't tell me that I was not gonna be a partner at EY. Like, that was, my dream, but somehow I got the bug, I think from living in London while I worked for EY, I got the bug to do more and become more like, dig more in the finance side, and so that's where I moved to BlackRock, which was a great experience and great in hindsight, I didn't even realize it, but great for me from becoming a CFO because it helped me understand institutional finance, and I think for especially public company CFOs or pre-IPO CFOs, you have to understand institutional finance because the big asset managers will eventually be your investors. And so that was super helpful. And then after BlackRock, I moved to Google and I worked in tax, tax slash treasury. It was like a joint role. Moved on from that to controllership and then moved into cloud FP&A and a go-to-market team. And so now at CXApp, I'm like bringing all of that experience together, Google Cloud and AI and all of the buzzwords, institutional finance, audit, compliance, you name it, I do it.
That's great. You mentioned the difference between a public company and an institutional finance. I wonder if you could just dig
Yes.
into that a little bit more for us. Like, what are the kind of stark realities, the kind of the differences that you encounter,
Yes.
especially when transitioning from one to the other?
Yeah. So I think and maybe I could just kind of like highlight like differences jumping from like consulting to, you know, BlackRock and Google, and then from that share size to like the private company I went to, my first CFO role, and then to this company. So when you're a consultant, it's easy to provide advice in a vacuum, right? Like you're not living it. So, one of the things I would do at UI, I would write a very beautiful memo, or it would become beautiful with a lot of help from a lot of people. We would deliver that memo, when I was on the tax side, and the same thing in like advisory. It's a report memo, same thing. You hand the report or memo to the client and you say, good luck, implement it. And so you walk away. But when I moved to BlackRock, it was a very stark reality of having to actually do the work. And then just seeing at both BlackRock and Google how you operate at scale, you have, I don't want to say ample resources, but you have resources so you can hire teams to run really good, heavy, media efficient projects. Fast forward to my current role, you don't have that same level, like, I don't have the same access to resources that I did at Google, right? Like, or that I did at BlackRock. And BlackRock was pretty, I don't wanna say tight, but pretty strict about spending. But, like, I'm at a much smaller company, we're a micro cap, and so the amount of resources and learning how to do I hate the phrase doing more with less, but it really is doing more with less, and just learning how to operate with the same rigor that you would if you were at a big institution, but being able to do it at a smaller company.
Yeah, this sounds like a real stress test in a way.
Yes.
I know.
Yeah, yeah. Yeah. And one thing I wanna bring up, you still have the same regular like, I still have as a public company CFO, like, my regulatory requirements are not any different just because I'm a micro cap, like, I still have to put out audited financials on a quarterly basis. I'm in the middle of our audit right now. Our 10K will come out, sometime this quarter. And so I'm still held to the same rigor, just with less resources. And so there is a difference from going from like the sheer scale and size of a BlackRock and a Google to a smaller company.
Would you think it's good though, like from a career perspective, to have to operate within those different roles? Do you think it sort of
Yes.
does it give you different skills? Like maybe you could dig into what you've had to learn a little bit.
Yeah, so I think I would say yes. So, like I talk about audit and I own the audit at my current company. Like I was an auditor before, so I knew it went into an audit, but being the actual owner and understanding it and understanding, really understanding the regulatory framework, really understanding internal controls, like on the practical side, not on I don't want to say it's easy from an auditor standpoint, but being able to look at, okay, the company and figure out how to get us to a place where we are reporting on time, where we have a solid financial foundation, where we again, I'll keep using this term rigor because it's really important, where we have the rigor and we operate as if we are that size, but we're not. And so just having to be a bit more hands-on, it can be scary when you come from a big company, but I've learned so much and like I can really say now there probably isn't any role in finance in any company that I can't do. Like, on any given day, like, I'm an AP clerk and, I'm a CFO, like, I'm doing a podcast now, and so, oh, it's glamorous, but, like, I'm gonna get off the phone with you, and I'm gonna have, like, 1,000 emails, and one's gonna be like, "Oh, check this bill, check this journal entry," and so, being very hands-on, like, is good because I've also learned the business really, really well. Like, it is easy to be I think when you work at a larger company, to be a bit more hands off it again, even in a finance function, like offer advice a little bit in a vacuum, I can't do that in my current role. Like I can't do that at all. Yeah.
No, it's a good argument, I guess, for because I mean this is what we're going to get to later in the conversation, but we're talking about strategic CFOs
Yes.
and things like that. It sounds almost like, and a big part of being strategic is being holistic, right? And not being
Yes.
in silos. Sounds like you don't have an option sometimes. No.
I know. I know, which is good. I mean, it's been great. It's been a learning experience, but no, I do not have the benefit of sitting in an ivory tower, unfortunately.
Cool. It's great. It's great to hear. Right. Okay. So you describe yourself, I think in your LinkedIn profile as a finance transformation architect. I find this to be a really interesting term. Can you describe what that means in practice to you? And also like what are the first signals that like an institution needs like broad finance change, transformation, not just kind of incremental change?
Yeah, yeah. So I think about transformation in a couple of ways. So, right, like everybody, when you hear transformation now, probably immediately goes to AI. And yes, that we'll talk about that. But I think before you even get to AI, you have to look at people and processes, right? Like transformation starts with people. I've worked on small transformations, large transformations, and I have seen them derail because people don't focus on the people first and the process, and they wanna go right to the end goal, like, "Okay, let's get a business requirements document, let's write down the requirements, let's go into testing." But before you even get there, you need to, like, spend some time on architect and, like, architecting the process and the people, and sometimes it's, like, the actual people in the roles or the people you'll need. And then, like, there are a couple of signals or 3 signals I wanna talk about. Sorry, I really wanna dig into some of this because I'm pretty passionate about it. Um, One signal is, like, finance teams from a transformation standpoint, I think going into the future, finance teams need to be forward-looking versus, looking at history. And even FP&A teams, like, I know everyone who's in FP&A will say, "No, no, no, I'm forward-looking." But if you're reporting, like, budget to actuals and what happened last month or last quarter, right, that's historical, and if you're a controller, and I'm an accountant, and if you're, like, providing the financials from last month or last quarter, that is not transformational to a business, and that is very, you know, backwards looking. And so I think the way teams can be forward looking is like, okay, taking all of the context we have, here's where I think we are headed. Here's where I think we should invest. Here's like, a lot of people talk about 13-month cash flow and forecast. Here's where cash is headed if we do this, and just being proactive and putting your neck on the line and giving suggestions. I think that's really hard. Signal 2 is that sometimes leadership is making decisions without finance at the table. That makes me cringe. I've seen it happen before, not so much in my current company because we're so small, and, like, I literally sit I'm not in my office now, but I literally sit, like, an elbow away from my CEO, so it's, like, really hard, like, I will hear his conversations and he'll have to go out the room, so it doesn't happen that much, but, like,
Like,
sometimes.
I'm watching you. I can
Right,
see
like
it.
you hear, like, he can hear my conversations, I can hear his, but one of the signals is, like, that, transformation might be needed is that if you see leadership or teams, depending on the size of your business, making decisions without you, there's a signal that transformation needs to happen, and part of that probably comes from going back to signal 1. You need to be providing forward-looking advice and guidance, and, like, again, putting your neck on the line and saying, "This is what I think you need to do." And number 3, if you are noticing that, again, going back to processes, that your processes can't scale, you're gonna be a hindrance to the business. So, I'm very passionate about transformation, but I think transformation a lot of people wanna talk about transformation, they dive right into technology. I start first with people. Do you even have the right people always talk about tech stack. Do you have the right people stack? Right? Like, who cares about your tech stack if you don't have the people to operate it? So, again, I think, there are a couple of signals to look at that will say, "Ding, ding, ding," like, we are ripe for a transformation.
Yeah, definitely. I love how you broke that down. And I think I think a lot of CFOs of finance leaders will definitely relate to the frustration that you're describing
Yes.
of kind of
Yep.
just like, what is going on? I've got no
Yeah.
idea what
Yeah.
people are doing.
Everybody stop. Pencils down, everybody.
Yeah, absolutely. Yeah. Okay, so you've been involved in kind of strengthening governance, improving reporting discipline. What is like the, in your opinion, is the common cause behind audit breakdowns or behind regulatory or audit breakdowns? Like, what do you think are some of the main reasons or main causes behind those things?
Yeah, I think a lot of people treat, regulatory compliance as like a tick box or check box exercise, and don't look at compliance or regulatory compliance, 1, as an enabler and, like, as a strategic enabler, and I'll get to that, and 2, just a solid foundation for the company to grow. Um, 1, I see, like, a lot of pre-IPO companies that are like, "Oh, we're going public," and, pre-IPO or pre-transaction companies, whether it's pre-IPO or acquisition, and they've never been through an audit. Big, 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 big mistake. Again, because someone may look at it as like a checkbox exercise. Again, going back to the people, not the technology. They may not have the right people in place. They may not have a controller or a controller who's lived through a public company audit or some type of transaction. They may not have a CFO who's lived through any of that because the focus has always been growth. Growth is great, but growth isn't great if you can't go public or you can't do a transaction because you don't have audited financials. And then on an existing company side, I think companies forget, or like maybe non-finance people forget, that you can use your public filings as strategy, right? Like, you can use your public filings to tell a story. I was just looking at a friend of mine who's a CFO was looking at their annual shareholder meeting, their proxy, and part of it told the story of the business, and I was like, "Oh, that's interesting," because the proxy, and this is no, diss on my company, but the proxy we put out last year was very, it was good, but it was very much regulatory. But there's a way for even your proxy to be strategic, one, on the things that you actually vote on, and two, in the proxy and annual shareholders meeting, I'm kind of mixing this all together. Two, you can use that time to use your proxy statement to tell more of the story of the company that you probably haven't done, or to continue the story that you told in your 10K and in your 10Q. So I think people look at regulatory, again, compliance is just like a checkbox exercise, and they need to look at it as like an enabler for growth.
Yeah, I love that. I love it as an opportunity for storytelling, especially. I've
Yes.
honestly never
Yeah.
ever thought of it from that
Yeah.
angle. That
Yeah.
we talk a lot about on the podcast about how data tells a story,
Yes. Yeah.
and I know that's how, well, stats or figures or
Mhm.
anything that you want to talk about
Mhm.
like that. I mean, I think, and that's something as well, isn't it? Going back to what we were talking about as CFOs being strategic partners.
Yep.
I think, correct me if I'm wrong, but I think a lot of the time it's about making the figures tell the story, right? Or being
Yes.
able to interpret the story and convey what it
Yeah.
is effectively to people in the room, right?
Yeah. Yeah, yeah. I think one of the most underrated skills of a CFO or anyone in finance is being a good storyteller. And my background is accounting. I'm also a lawyer, so I've always, not always, but there are times where I've leaned more on the technical, right? Like, gotta be technical, gotta be right technically, gotta be accurate, gotta be this. And that's all fine. And you should. That's kind of table stakes. But what I realized over time, the most effective and impactful CFOs and finance people are the ones that are able to tell a good story to the market, a good story to investors, a good story to the board. Like, you have to be able to tell a really good and compelling story.
Yeah, and not just of where we've been, but where we might go, right? As
Again
well, like,
again, that goes back to my being strategic. You can't just sit there, it goes back to signal 1. You can't just sit there and talk about what we did. You need to talk about, "This is what we did, and this is where we're going, and here's why."
yeah, definitely love it, definitely. Okay, so for finance leaders that may be listening to this, can you think of,
Yeah.
some practical tips maybe for to increase audit readiness without like causing massive headaches with head count or things like that, right?
Yeah, 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 and so this is where I'll get into my AI spiel, because I feel like I talk about it all the time. I mean, AI is in our ticker. Um, but one, what I'll talk about what I've done. So 2 things. 1, close the books faster. Um, and I know that sounds cliche, but if you are taking more than 5 days to close the books, that's too long. And even with closing the books in 5 days or 3 days, I think you can look into closing, like, continuous close. So, what accounts can you reconcile on a daily, weekly basis so that by the time you get to close, it's really seamless? Um, there are some tech companies out there saying that they close in 1 day. I haven't seen that. We have a short close. It used to be long. We've shortened it significantly, like cut it by 50, 60%. And again, it's by doing some of the reconciliations. The other bit on getting audit ready is just looking at all of the hairy bits that you may have as a company, right? Like, you know, the really, really technical stuff that you'll have to write technical memos on, you could start to do that now, and guess what? ChatGPT, Gemini, Claude, Perplexity, they're all great at it. Now, I'm not saying just use it, write it, and then, like, shift it to an audit, but, like, start to get in that habit of doing that, so that you get to a happier place. And sorry, I said 2 things. 3rd thing, and very, 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 very important thing, whether it's whether you're getting ready for audit, IPO, acquisition, anything like that, make sure your revenue is right. I know that sounds crazy, but, like, before you get to an audit, I think you should practice auditing yourself, and you don't need to hire anyone to do it. I think you need to sit down and look at your rev rec processes, and, you'd be surprised at how often this comes up for companies of all sizes.
Yeah, yeah, I can imagine, definitely.
Yeah.
Great. Okay. So let's talk a little bit about how, the sort of IPO readiness, which is kind of the main thrust of this conversation, how that's kind of shifted since the pandemic or before the pandemic.
Yeah,
So from
yeah.
your perspective, like what has been the biggest shift?
I think the biggest shift is the amount of ARR in just real revenue you need to go public now. I think before the pandemic, um, you could have $100 million in revenue, sometimes less, but that was, tricky. Well, you could have the standard $100 million in revenue, $1 billion valuation, and you would be able to go public, right? And then during the pandemic and a little bit before, we saw the like onset of SPACs, and that, I work at a company that went public via SPAC. And so that all kind of worked for a while until it didn't. And now post pandemic, the investment bankers are a bit more aggressive. Like, I don't know what the average is, so don't quote me, but I think like the average IPO in the last year or so, the ARR was like north of 200 to $400 million. That's double. That's huge, and so, what does that mean for companies that wanna go public that are pre-IPO that have been in the trenches for a while? Some of them just may not go public, and so you have a lot of companies that are really solid that are in that $1 billion, $2 billion valuation, maybe fifty million to $200 million in revenue that may never go public. And I think if you're sitting at a company like that and you're a CFO and it doesn't look like you're gonna grow, like, I think you should look at other strategic opportunities. You know, private e private equity, maybe acquisitions, maybe joint ventures, maybe an exit through a sale to a strategic, but I think, there's a whole host of companies that had the required revenue that you need, and I call it air quotes because it was never required, but a air quote "required revenue" that you needed to go public pre-pandemic, and that the goalpost is totally moved.
Wow. Okay. So it's a complete shift and a lot of pressure
Yes.
there, I
Yeah,
suppose,
a lot of
Yeah,
pressure,
yeah.
a lot of pressure, and unfortunately, right now, it's skewing very much towards a lot of tech companies, a lot of the AI companies, because their valuations are huge, their revenues are large, and so that 200 to 400 million may even shift even further. We'll see as 2020, we're early 2026, so we'll see what happens.
Yeah, definitely. Yeah. Exciting yet scary future. Trying.
Yes, yeah.
Trying both. Yeah. Okay. So, speaking of the future, and things that are potentially scary and also kind of exciting as well.
Yeah.
You know what I'm getting onto now? AI. So let's talk a little bit about AI, and I'm really curious as someone, your experience in
Yeah,
finance. I
yeah.
want to know, like, what were your first thoughts on it in your particular function? Like, and what do you think its role is now? Like, chart the kind of evolution for me of like how of your thought
Yeah,
process behind it and how you use
yeah.
it.
So, if I had to be honest, when it first came out, I think so this was probably when I first started using an LLM, a large language model. I think this would have been in 2023, 24, so not that long ago, but I was using it for very basic things like, "Help me write an email to a board member," or, it was very, very, very basic. Fast forward to today and I can before Claude Bot came out, so Claude Code and all of that, I was able to create, an FP&A scenario planner within one of the LLMs and created my own agent. And because of how I've, like, programmed some of my LLMs and because it's behind our firewall, I've gone from, again, very basic, help me write an email to a board member to my CEO to help me create, like, 5 to 10 different scenarios where in the past I would have just done 3, and I have an AI agent that helps me do it, and within minutes versus what would take days, if not weeks, and so I think the evolution is exciting and scary. It's exciting because I think finance folks are gonna be able to do more quicker. Again, going back to that signal, providing insights, we're gonna be able to provide insights, like if a business comes and says, "Hey, if we change pricing, what does that look like?" Before, you'd have to open up your pricing spreadsheet, take it in, or open up a tool. Now you can just run some simulations in an LLM with the agent or depending, we have to talk about Claude Code or if you use Claude Bot and like let it work overnight and do it for you, which is like, whoa. That's exciting. The scary part though is twofold. One, there is, and I'm a little bit old fashioned, there is some beauty doing math the long way. You know what I mean? Like there's beauty in knowing how to do advanced multiplication by hand. And if you just use AI for everything, you lose that skill of being able to critically think, right? Like, and I don't think critical thinking skills are going to go away, but we're getting to the point where some of us rely on it so much that you have to remember, well, no, 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 no. Like, I have to look at the output and think critically. So that's one bit. And then secondly, I do get a little concerned. It's kind of related to this for entry level folks because I had to do audit by hand. I had ticked and tied with a pencil. I'm not saying you need to do that, but if you like learn how to audit with AI and analytics, it's probably good and you'll get the insights, but I think there's still something again, I will always think this way. Like there is something to be said for doing things the long way. And again, I call it by doing multiplication and division by hand. Like being able to do it by hand and like the memorization of having to do it, you understand the logic behind it, right? And so you understand the rationale. Whereas now you just get the answer and you can give the answer, but what about the rationale behind the answer? And so I'm excited for it, but I also caution people to really, really dig down into like, do you understand like what the tool gave you, the output of what the tool gave you?
Yeah, there's learning, isn't there, in friction as well, in making
Yes.
mistakes. And,
Yeah.
I mean, I
Yeah.
God, you know what, you gave me flashbacks to being 11 years old and trying to figure out long multiplication and long division and just the horror of it. And then and
Yeah.
then sitting with my parents at the table and like
Yeah.
finally getting it,
Yeah.
like sort of like
And you could have just done it with a calculator, but I remember they would be like, "You're not gonna have a calculator on the test," so it's like, "My god, I
you
better
gotta
learn."
do it.
And you don't use, like, long division, like, unless you're an engineer, some finance people just do it off the top of their head, but, like, it's good to know how to do it.
Yeah, definitely, definitely. Yeah,
Yeah.
I think we and this is the scary thing, and it's not just numerical either. It is
Yeah.
also the verbal. I
Yeah.
mean, I've always been someone who's more like verbally inclined, like language and things like that. But I found myself declining a little bit at times. I really do think so because it is so AI is so good at it, especially with
Yeah.
like kind of more corporate kind of speak a lot of
Yep.
the time. you just kind of, you'll sit there and you have to write something and you think, God, the words just aren't coming to me. Like,
What should I say?
because it, because it actually, because I believe it's not just like when you're growing up, it's also you have to keep practicing it. It's like a muscle,
Yes.
you have to
Yeah,
keep
yeah.
doing these things again and again and again and
Yeah.
again.
Yeah.
So I totally agree with you.
And reading books and, like, not necessarily learning new words, but staying sharp mentally is important.
Absolutely is, and I think that's the biggest danger,
Yeah.
definitely,
Yeah.
and that's one of those things, isn't it? Like, you can't close Pandora's box, it's not gonna
No.
stop at this point, like, but
No. No,
we
no.
have to learn to live with it, and, like, I think part of learning to live with it is asking these questions,
Yeah.
isn't it? No, no, no.
Yeah.
Let's talk in particular about IPO timing then and sort of internal readiness. Like, what kind of internal
Yes.
capabilities, whether that be financial, operational, in terms of governance, should be in
Yeah.
place before a company seriously like considers taking the plunge and going public, in your opinion?
Yeah. You almost answered the question with the way you asked the question, so so I would say 18 to 24 months and maybe a little bit longer. 18 months to me is just too short. That just doesn't seem long enough. You should have your systems in place, and you should have governance in place, and what do I mean by that? I mean that you should have lived through one audit, um, because if you live through one audit as a private company, that will get you ready mentally and I say physically, but mentally and from a system standpoint to go ready. So, like, I let's take out the 18 months. That's too short to me. At least 24 months, like, you need to have a roadmap to go in public, and if purely from a finance and accounting standpoint, strategy, investment bankers aside, that's a different part. But, like, from a real, like, tangible readiness standpoint, hire an auditor, maybe hire, an advisory company if you don't think your books are, um, in good shape, get your books gap ready, go through an audit, live with that audit and live with the results, and iterate based on that. And that is super helpful because that'll flesh out where you have any weaknesses that you need to beef up before you go public. Then there's, like, the institutional side, right, which you'll do with your investment bankers and, like, crafting the story, and you've been doing that all along, right, with capital raises, Series A through whatever, but now the story is different going back to my conversation about institutional investors, like, the story before was to VC companies, the story now is to institutional and retail investors, which have a very different investment thesis and what the VCs have. And so you need to be able to think about what that value prop is going to be for an institutional investor if you're trying to get them to invest in your company and have the institutional investor take your company and put it into one of their funds. The story is very different. I mean, the due diligence is the same, but the story and the value prop is really for institutional investors, long-term value creation, long-term returns. Same for VCs, but with a bigger pop. And so, like, let's say you want to go into the S&P 500 or Russell 1000, you need to start to craft that narrative. I would say, 18 to 24 months before you go public. So governance, value creation, and again, I think we talked about, revenue. I cannot hone on this enough. Like, your ARR is gonna be super important, and make sure you have, like, whatever we are all saying in the finance community now that the requisite ARR is to go public, like, make sure you have that and make sure it's real.
That's great. Okay, well, we're coming to a close now, Joy. I think maybe we could just talk a little bit about what your kind of like, if you had, like, sort of perfect, like, a perfect world, rosy
Yeah.
sky, blue sky, rosy thinking kind of thing. What would the
Uh-huh.
place of a CFO look like in a company? What do you think is like the kind of dream position?
Dream position would be, with a good support system. So again, I'm always going to talk about people because I'm a people person. So I believe you need to put people first. So For me, a dream scenario is having, like, an amazing controller, an amazing head of FP&A, and if I get to, like, icing on the cake is, like, a great treasurer, but that could also be a controller depending on the size, a great IR person, but you can outsource that as well, but, like, table stakes would be a great head of finance, VP of finance, and a great controller. And then, like, a great relationship with the rest of the C-suite. It's not gonna be perfect, but, like, a great relationship with the CEO. Mm, I think a lot of people probably discount how important a CFO-CEO relationship is, like, it is super important. You have to have a working relationship with your CEO. And then I think also just having, like, a robust C-suite, like, my dream scenario would be like, 'cause I don't have this right now, and I didn't have it necessarily in my previous role, because these are smaller companies, but if I were at a bigger company, it would probably go something like this: CFO, CEO, COO, maybe the COO was also like a CRO, but, like, there was some shared responsibility between the CRO and CFO, COO. CMO, did I say that? 'Cause, shout out to chief marketing officers, a chief people officer, a solid GC. So, like, I would say, like, the C-suite has to be, like, the Avengers. Like, I would want the Avengers of the C-suite. That would be, and then, like, my team, like, my 1 and 2 would be, like Batman and Robin. So that would be an idea. So for me, it's all people because the technology tools are out there. People is the hardest thing. Not everybody. I know all the tech people are gonna be mad at me. Like, our ERP is special. Yes, people are coming up with really good ERPs, but like finding the right people, in finance and finding the right people at the C-suite level is like magic.
Yeah, and it's gonna get more important than ever, right? As more and more people are adopting AI, it's just gonna become the standard. The thing that's
Yeah,
gonna differentiate people
yeah,
ultimately is their people, isn't it? That's the
yes,
it's
yeah,
I mean, it seems
yeah,
pretty
yeah,
logical to me, really.
yeah,
Absolutely. Okay, one final fun question before I let you go.
yes.
What is the one kind of thing that you hear people say about finance leadership that really irks you? You'd really like to send to Room 101? Like,
Yeah. That we are, like, there's a joke around some of my CFO friends that we're like CF no, and, like, we always say no, and that's all we do is, "No, don't do that. No, no, no." And I don't think that's true, right? Like, I would like to believe that I am, as much as I say no, I try to give as many yeses, and I'm not just a like guardian of the business and like a governance general, but I'm also like a value creator and like I'm a chief growth officer. So I think the misconception is that we say no all the time. I think people have to remember that we are guardians, we are stewards, but then there's also a part of us that are all about value creation and hyper growth.
yeah, definitely. I think that's a great note to end on. Thanks so much for your time today, Joy. It's been a pleasure.
Thank you. Yeah, no worries. Thank you so much.
And that wraps up another episode of the 2 Cents podcast. Thank you to our listeners for taking the time to tune in. If you enjoyed this episode and want to hear from more finance leaders like today's guest, please subscribe to the show and leave a rating or review on your favourite podcast app. It would mean so much to me and my guests if you can show them some love and appreciation for sharing so many great insights with us on the show. Again, thanks for listening. See you in the next one.